we're going to review the current ratio. The numerator in the current ratio is all the current assets. The denominator is all the current liabilities. And that will give you the current ratio. It is expressed as a number and not a percent. So 1.2 or 4.5 or something like that. So we're going to do it for General Mills for 2011. So we're going to go get their balance sheet and look under assets and get their current assets. That's our numerator. Then we're going to go to their balance sheet, look under liabilities, and get their total current liabilities. And then we're going to compute the ratio by putting the current assets on top of the current liabilities, and we get 1.07. And now let's try to interpret what that means. So the current ratio is a measure of short-term liquidity. It's interesting to creditors and vendors primarily because they're the ones who want to be paid next year, and so they want to know, do you have enough cash or near cash things, the current assets, to pay the bills that are coming up in the next year, which are the current liabilities. So if the current ratio is below 1, it means you have more obligations. So the denominator is bigger than the numerator. You have more obligations coming up in the next year than you have cash or near cash items. So what's a near cash item? Like accounts receivable should be cash in a month. Inventory, maybe it takes you 2 months to sell and another month to collect. So inventory might be 3 months away. But those are cash or near cash items in current assets. Typically, a current ratio above 1 is considered reasonable, and above 2 is considered solid. If you're much above 2, then that's not really very helpful because once you have enough to pay the vendors, having extra doesn't really matter. In fact, idle cash is really not seen as a good use of cash because it doesn't earn any money, and so it's considered dormant. So really, above 2 is no different than 2. You passed, you've got enough current assets to meet your current liabilities, and so you would move on to some other part of the business. There wasn't anything more to learn. This ratio is like pass-fail, and if you pass it, then that's it, and you keep looking at other things. So just to compare, I went to Kellogg's and got their current assets and their current liabilities. I got this off of Yahoo under the finance section, and I went and looked up General Mills and clicked on their competitors in order to get a comparison point. Now Kellogg has fewer short-term assets than they do short-term liabilities, so they're below the 1. So they would be considered a short-term liquidity risk, while General Mills was not. So they didn't pass the ratio. So what would Kellogg's do about that? If you look in their financial statement, they have a short-term line of credit, so they can get their hands immediately on extra cash as needed. So if you are a creditor or a vendor, you would want to know, okay, what are you going to do if you're short? So you would want to be sure that they had some way of raising cash quickly.